Everybody, Dan Roach here, University of Options. Happy Sunday. I hope you had a good weekend. Really hot where we are in Northern Cal, like 108. Okay, so speaking of hot, market has just been unbelievable. And the economy is showing great resilience, although there's enough signs that I'm still nervous. But you know me, I just tend to be a little bit of the eternal bear, maybe. No, not eternal bear. Eternal, I forget what you call it. Contrarian. There you go. So first slide, IMF. Basically this is the global GDP. The forecast is at 3.3 for 2025. Nice healthy number, up 2/10. The upgrade is driven by, guess what? Improved economic outlook. And we see advanced economies showing resilience. By advanced, we're talking about more of the advanced countries. And emerging markets are facing more mixed conditions. Doesn't necessarily correlate to the advanced economies, but it's something to watch out for. Inflation trends, 2.9, down 1/10. So we're seeing this modest cooling. Energy prices stabilizing. Housing costs remain a bit elevated. And the Fed is continuing to monitor 2% inflation target. Unemployment still hanging in at 4.1. We're seeing more jobs open than we did before the pandemic. And wage growth is moderating, but it's still pretty good. It's the moderating part we need to be careful of. This is the Fed. Probably the number one thing they're looking at alongside of inflation to determine whether or not there should be rate cuts. And the labor rate is improving gradually, but boy, it's got a long way to go. Federal Reserve policy, holding between 4.25 and 4.5. The Fed said they're data dependent, to which I say, duh, what else would you be? The question is, how are you interpreting the data? And then the further concern here is the balance sheet reduction continues. If the Fed is reducing their balance sheet, that means they're selling bonds. And that is really going to multiply the interest rate issue we have. So my feeling is if you're too stubborn to lower rates, I almost said dumb, but I won't be that mean. And why do you have to also reduce your balance sheet? And the market's still looking for cuts later in 2025, although the percentage of people expecting a cut in September has dropped dramatically. 10-year Treasury did fall to 4.3. It actually got down as low as, I think, 4.2 and then bounced a little bit on Friday. If you listen to my daily bond market report, I cautioned you that a bounce was due. Not just because I say it's due, but it would hit that level exactly as the Fibonacci 50 level, where we often look for a bounce. The yield curve remains inverted, which is continuing to predict an inflation. The last seven recessions were accurately predicted by a yield curve being inverted. There's strong demand for government debt, which is good. That's what helped bring down rates 10 basis points. Consumers are still spending almost $19 trillion. We're seeing good resilience there, which has kind of been the case. And we're seeing the services part of the economy is outpacing the goods. Doesn't mean much, but it's something, again, to watch. And credit card spending growth is slowing down a little bit, which is important for the overall health of the economy. And retail sales exceeding expectations. Okay, I'm back. Where are we? Next slide. Manufacturing indicators. This is the Institute of Supply Managers. A number below 50 is considered contraction, aka recessionary. New orders are showing signs of stabilization, which is good. They're not falling. Inventory levels are normalizing, and we're not seeing a whole bunch of supply chain disruption. All that's good, except this needs to get above 50 for me to feel comfortable about the economy overall. I'm not sure if this number is right. I've seen a couple numbers that were funky in this presentation, but it's showing that home prices continue an upward trend. I think there is some truth there. I don't think that 420,000 is the right number. I apologize for that. Could be. Mortgage rates are definitely affecting affordability. Duh. In fact, homes are about as unaffordable as they've ever been in history. We're still seeing some constraint in inventory, to which I would say thank goodness, because if inventory starts growing, you're going to see housing prices plummet. This is what's keeping housing prices holding up, certainly not interest rates. Global trade, we're seeing that the trade volumes are recovering. The trade relationship with China is stabilizing. That's good. European demand showing some resilience. So all in all, the trade wars are not all that deadly. They're not really causing problems. Oil prices, $73 a barrel, which is okay. We're not seeing signs of increased pressure on oil at all, although oil has gone up 2%. Where we're seeing pressure is things like the Saudis just said they're going to, I think, double their production. So this should start taking oil down, which is going to help inflation across the board. S&P, new record, 63.89. We're seeing amazing momentum in 2025. I think this is now the second best year in history in terms of results year to date. And pretty much rallying across all sectors. And market optimism is definitely still driving things higher. KBE, that's the builders ETF. So that's a fund that only buys builder stocks, and up 5.2%, showing bank record profits. Banks love these high interest rates. You're seeing their margins are expanding. Credit quality is good. So the banking environment is healthy, and this typically will tell you that we're not in immediate risk of a recession. Technology up 2.5%. I don't even know what to say about this anymore. It just keeps climbing, but guess what? So do earnings. Earnings seasons, that should be 2025, sorry. We're seeing a lot of earnings estimates are getting beaten. We're seeing growth revenue exceeding expectations. Margins are expanding across almost every industry sector. But when you listen to these earnings calls, the CEOs, CFOs are showing some concern about margin compression coming. The financial sector, we just talked about that. That's the KBE sector. And you can see that they're definitely strong. Healthcare is resilient. Energy is good. Utilities are facing some headwinds because of interest rates. But when you see these sectors all climbing, this is a good sign. The VIX is so low, $16.20. This is telling you there's very little, if any, fear in the market. Watch that number. You know, if you see this go above 20, you know, there might be maybe some problems coming. And the international markets, the MSCI global markets, they're following our U.S. leadership. So they're as strong as we are, up 2.1%. You can see European indices are posting gains. Emerging markets are showing divergence, and currency movements are beginning to impact returns. TLT, this is the fund ETF that buys 20-year bonds, and this is the price. The price declined, so that's a good thing actually. In terms of for interest rates, sorry, this is for rates declined, which also put pressure on prices, or you could say that vice versa as well. Corporate bonds are outperforming treasuries. That's because they pay more. Gold, almost $4,000. Sorry, almost $3,400. Unbelievable, unstoppable. And at some point, I think we're going to see a major pullback in gold. I'm watching for that. I plan to make a lot of money when gold starts pulling back. And we have positive momentum everywhere we look. Bull market momentum is continuing. The economic fundamentals are supporting this growth. Corporate earnings are driving these valuations and justifying them. And all the risk factors that we can see are manageable. This all looks so good. If I weren't a contrarian, I wouldn't be hiding under the desk right now, but I am. All right, guys, that's all I've got. Thank you so much. Talk to you later. Hey, guys, it's Dan. This is like take 3 on the last 1 minute of this video. I noticed that the slides did not show. And I wanted to show my handiwork here. So last week on Sunday, we suggested DraftKings above 45.02. We gave a target of 47. It blew right through the target and went all the way to like $49. That was a massive trade. I hope that you took it. And then we talked about Merck, the drug company, and we said get in above 79.85, gave a target of 81.20, got just within pennies of that target. So two great stock picks, lots of money made. Definitely outperformed the general markets. The markets did good, but not this good. So this week we've got, don't miss these, Kroger's above 79.70. Don't go in unless it closes above 79.70. And we've got Ross Stores above 146.05. You can see your targets up here, and you can see your stop loss down here. Okay, that's it. Thank you. Bye.